If you are retired right now, or if you are getting ready to hand in those keys and walk into your golden years over the next few years, I need you to stop what you are doing, sit down, and pay very close attention to what I am about to tell you, because the government changed the rules of the game, tax changes are hitting retirement accounts, and if you do not understand what is happening to your money right now, you are going to hand over thousands, and I mean thousands, of hard-earned dollars to Uncle Sam that belonged in your pocket, for your retirement, for your security. People come to me all the time, and they say, Susie, I worked 40 years. I saved in my 401k. I stayed out of debt. I did everything right. Why am I getting hit with a massive tax bill in retirement? And it breaks my heart. Because no one told them. No one warned them about the tax traps waiting for them. But today, I am warning you. I am going to shine a giant spotlight on what is happening with tax rules, what it means for your Social Security, your IRAs, and your 401ks, and exactly what you need to do today so you do not stand there standardly broke in your 70s. Let's talk about the biggest fear every single retiree has. What is it? It's running out of money. It is the fear that healthcare costs, inflation, and taxes are going to eat away your nest egg until there is nothing left. And let me tell you, that fear is real if you stay on autopilot. Look at what is happening with retirement contribution rules and tax changes under the Secure 2.0 Act. The government is changing how you can save and how you are taxed. If you are still working and you are age 50 or older, you've probably been making what they call catch-up contributions to your 401k or 403b. You put that extra money in pre-tax, right? It reduced your taxable income today. Well, guess what? The IRS said, oh no, we want our cut now. If you make over $150,000, those catch-up contributions are forced into a Roth account. That means after-tax dollars. You don't get that immediate tax deduction on those catch-up dollars anymore. Now, is a Roth bad? No! You know how much I love a Roth. I have been screaming from the rooftops for decades, Roth is boss. Why? Because when you put money into a Roth, it grows tax-free, and when you take it out in retirement, you pay $0 in tax. Zero, so while it might hurt your tax bill today, it is a blessing for your future self. But here is the problem: if you don't adjust your cash flow right now to account for that loss of a pre-tax write-off, you are going to get a very nasty shock when tax season arrives. Now, let's address another question I get constantly. Susie, what about my required minimum distributions? My RMDs? Listen to me. The government does not let you keep your money in a traditional 401k or traditional IRA forever. They deferred your taxes while you were working, but eventually, they demand their piece of the pie. They force you to take money out whether you need it or not. That is your RMD. Under the new rules, the RMD age has pushed back to age 73. And down the road, it's moving to 75. Now, a lot of people think, great. I can wait longer before I take money out. Stop right there. That is a trap. Do not fall into that line of thinking. Why is it a trap? Because if you wait until age 73 or 75, your traditional IRA has had more time to grow. That sounds great until you realize that a bigger account balance means a bigger mandatory withdrawal. And when that huge withdrawal gets added to your income, it pushes you into a higher tax bracket. If you are drawing money from a traditional IRA to live on, every single dollar of that IRA withdrawal counts as income, which then causes your Social Security to become taxable. It is a vicious, compounding tax cycle, and it is draining retirees dry. So, what are we going to do about it? You know, I never give you a problem without giving you the solution. I want you to take control. I want you to stand in your truth and take action today. Here are your non-negotiable action steps. Number 1, the gap years strategy. If you are retired or retiring before age 73, look at the gap between the day you stop working and the day your RMD start. These are your golden tax planning years. This is when your income might be at its absolute lowest. During these years, I want you to look into strategic Roth conversions. Move money from your traditional IRA into a Roth IRA slowly, chunk by chunk, up to the top of your current low tax bracket. Yes, you pay a little bit of tax today, but you are paying taxes at a lower rate now so that you never pay taxes on that money ever again. No RMDs on Roth IRAs. No Medicare premium spikes down the road. Total freedom. Number 2, if you are age 70 and a half or older, you need to know about QCDs, qualified charitable distributions. If you give money to charity, do not write a check from your personal checking account. Do not do it. Instead, have your IRA custodian transfer the money directly from your traditional IRA to a qualified charity. That money counts toward your RMD requirement, but it never shows up on your tax return as income. It lowers your adjusted gross income, protects your Social Security from being taxed, and keeps your Medicare premiums low. That is how you play the game smart. Number 3, take advantage of the standard deduction changes and special senior allowances available to you. Make sure your tax preparer or your software is maximizing every single senior deduction you qualify for. Do not leave a single dime on the table. Listen to me, money flows where heart and wisdom go. Ignorance is not bliss when it comes to the IRS. Ignorance is expensive. You have worked too hard, sacrificed too much, and saved too long to let tax rule changes strip away your peace of mind in retirement. Take a look at your accounts today. Talk to a trusted, fiduciary financial advisor or tax professional who understands these new rule updates. Get your plan in place. Protect your money, protect your family, and secure your future. You can do this. Be strong, be smart, and stay safe.